if you're familiar with Market Gauge, if you could just put familiar or never heard of you, or really like you guys or really don't like you guys, something in the chat box. We can be real, and I'll make sure I can see that you're um, doing any comments. And and then I'll encourage you during the presentation to ask some questions. This is going to be in my view, kind of a working webinar. I'm going to show you a few slides, and then I'm going to dive right into the tools that I use to anticipate the market's trend. And the reason, in my opinion, to anticipate the market trend is to literally put the wind at your back. And I mean, how many of you would agree that when your trade is going in the same direction as the market, that it's a lot easier to generate bigger profits, easier profits. They come faster. It's just a lot easier. So that's my focus for this presentation. How many of you spend time with general market timing? So if you spend time trying to figure out which way the overall market is going, give me a yes. If you don't, then give me a no and say why not. And if you're somewhere in the middle, I guess you can put something along the lines of somewhere in the middle. And part of participating here is that it's not just for me, it's also for you. So if I have a chance during the presentation, I'm going to ask you questions, hopefully to get you to be thinking and paying attention to whatever the point is there. So you'll walk away taking a lot more out of it. All right, so I've got a couple people saying yes, but I know there's a lot more than a couple people on here. So I guess I should assume all of you who aren't saying yes are just saying no. I don't think you want me to assume that, but I guess my job is to show you why you should be. And because it doesn't need to be hard. Like a lot of people come into this game, hobby, occupation, thinking that market timing isn't worth the effort or you can't do this. But hopefully by the end of this, you'll be able to see that you don't need to be an expert to do this very effectively. And it doesn't have to be a ton of work. And most importantly, I am not going to tell you that you can predict which way the market's going to go every single day. Not in this webinar. In a different webinar, I would teach you about tactics like the opening range and some of the other stuff that we look at that we do use to anticipate which way the market's going to go on any given day. But this is more of a big picture. All right. So this isn't an everyday I know which way the market's going to go. It is a approach to the market so that you can know whether or not you should be bullish, you should be bearish, you should let your profits run, you should start thinking about taking some profits. And as I say here, the reason to do this is because if the trend is going your way, it's just a heck of a lot easier. All right. The other reason for me to do this is every weekend or almost every weekend, I write a piece called the Market Outlook. And the underlying theme of this article every week is that if you listen to what the market is telling you, you can really figure out what the market wants to do. All right. So the thing that make markets complex and counterintuitive is that most people are too busy listening to the rhetoric and the analysts and trying to figure out data that's not really relevant when all you need to do is look at what the market is telling you. So I'm going to show you how to do that. And I'm going to show you how it doesn't have to be complicated. And so in order for me to first lay a groundwork, I said I've got a few slides here. We're going to talk about what influences the market's direction. We're going to talk about a few simple ways to anticipate when it might change. And by doing that, you'll be able to put the odds in your favor. All right, so I am going to talk about methods that we currently use. I could be telling you easily what I think the markets are going to do, and therefore it's important for me to let you know that I am not a licensed financial advisor, and for that reason, access to this webinar is for informational and educational purposes only. All right. So, ultimately, here at Market Gauge, we're interested in helping you preserve, protect, and build your wealth. One of the most important things to doing that is to have confidence and to do it with discipline. So we're always looking at the markets through a very methodical and disciplined approach. And if you do that, your gains will be bigger, your losses will be smaller, and the markets will be a much more friendly place for you to be. Now, for those of you who have never heard of Market Gauge, we've been around since 1997 as Market Gauge. That's me on the top, my two partners underneath, Keith and Michelle. And so Keith and Michelle were traders on the floor of the commodities exchange in the 70s and the 80s. I joined them in 1990, right out of college, and I've been working with them ever since. So we do have a pretty special and I would say family atmosphere at Market Gauge. And it's also important for me to say that I'm the one doing the presentation, but I've got a whole team of people that make all this possible. In the mid 90s, Keith and I managed money at Millennium Partners, which is still today one of the largest, most successful quant-based hedge funds. And currently today, Keith and Michelle manage money at Market Gauge Asset Management. So if you're interested in having assets managed, I can point you in the right direction there. You may have seen Mish on TV or any of the major media outlets. She's all over the media, probably 10 to 20 times a week. All right, so when we start looking and trying to anticipate what the market's going to do next, the first few questions we want to ask ourselves is it trending? Is it overbought? Or is it reversing? All right, if you can identify which state the market is in, you'll already be halfway there. Now, in order to do that, let's take a look at just some core principles that are pretty much the driving factors behind what's moving the market at any given time. So the first is typically price trend, right? You're just looking at whether the price is going up and down. The second is momentum, and momentum, depending on how you want to define it mathematically, should represent whether or not the trend is accelerating or decelerating. And at times, momentum can actually be going in the opposite direction of price. And that, as you'll see coming up, is one of your best opportunities to identify a reversal, for example. When we're talking about the market, one of the advantages we have when we're looking at the whole market versus just an individual stock is that there are some really powerful ways to measure leadership. And since we're looking at a market, we're not just looking at one instrument, and that means we can look at different instruments that can give us some insight into which way the market might go. And we want to look at the leaders. Seasonality. So there's a whole bunch of ways to look at seasonality. We have very unique ways that we refer to as calendar ranges. The more traditional ways are just how markets have performed on average over the course of the year, the course of the month, the course of the week. Seasonality also comes into play when you start thinking about how does the market generally trade around, say, a particular segment of days, the beginning and end of a month, the middle of the month. So seasonality or particular months in general. I'm going to show you some charts. I'm not going to spend a lot of time on seasonality, but probably one of the most popular ones and one that should be on everybody's mind now because of the media is, the Santa Claus rally, which we didn't get this year. But there's a time segment of the year that the market has historically been bullish. That's an example of seasonality. Then there's sentiment. Now, there's a lot of different ways to measure sentiment, but at the end of the day, right, markets are always moving based on sentiment. It's what people think is coming next that is driving that market. Um, at at the core of everything is the economy. Now, that doesn't mean that if we have a strong economy, we're going to have a strong stock market. But what it does mean is that what's going on in the economy can and often does influence the direction of the markets, and not always in the way one would expect, but it certainly is a driving factor. All right. Now, underneath the economy, the two primary drivers are going to be growth. Is it growing or slowing? And what are interest rates doing? Now, when we come to companies, individual companies, it's going to be fundamentals, and I'm going to limit that to earnings, right? So I would say this is a pretty exhaustive list. I did leave a couple things out of here, just so we didn't go too far afield. For example, I didn't put in astrological conditions. I'm not a big, I'm not an expert there, but certainly seen some pretty interesting correlations between certain planets and the markets. But in this presentation, I want to focus on the things that are, I'm going to say, really real, easy to grasp, and things that you can really take to the bank. And in fact, in order to do that, I'm not even going to focus on all of these in a big way. I want to make it simple. But before I leave this slide, if you're taking a snapshot, which if you're interested in market timing or why markets move or even why any trends move, this is a pretty good list. In fact, this is a really good list. If you understand how to measure each one of these things, you will really be able to tell what's going on in a trend. Now, you don't need to use all of them. In fact, I'd argue you only need to use a few of them. But the reason I'm spending the extra time on this, let's look at this: price, momentum, leadership, seasonality, sentiment, the economy, meaning growth or interest rates, and fundamentals. All right. Now, the reason I said you might want to remember that is because nobody's going to remember that whole list unless you have that unique ability to just remember things. And now I want to talk about how do you get a great setup in looking at whether or not the market is going to reverse. So I call this the 3 boxes rule. If you have 3 of these things that are all telling you that the market should go a certain way, that is the time where you have what I would refer to as an A trade, a great setup. That's when you really want to dial in what's your risk and take a position. So trend. Is the trend going in your favor, in the direction that you want to go? Do you have a divergence? All right. Now we'll get into divergences coming up. This is high level. So this is a template. Do you have a divergence that supports the direction that you think the market's going to go in? Your levels. So I'm not going to teach support and resistance here. I'm going to assume that you understand what support and resistance is and how to find it. But support and resistance, simply by looking at levels, is critical. So if you're at a great level, then that would be another reason, right? So if you can check those 3 boxes, you are in great shape. But there's a fourth, and that is overbought or oversold. Now, again, there's a lot of different ways to measure overbought or oversold. I'm going to show you a few, and I'm going to show you this all in the context of, again, market timing. But this template would work for anything. If you wanted to figure out whether or not you should buy Nvidia today after yesterday's debacle, I would be looking at this particular list. Do I have three out of these things? If I have two, maybe not. If I have three, it's probably good. If I have all four, even better. All right. So I'm going to look at these, come back to them. And now let's dive right into how do we look at the overall markets. Now, I'm going to be showing you a few charts in these slides, and I'll jump right into the live charts or the more recent charts. But we have some unique ways of looking at certain conditions like momentum. And so this chart, to begin, is looking at two things. It's looking at trend. This is just a daily chart. A daily bar chart. You can put candles in here if you want, but when we look at the charts that I'm going to show you, we're going to have the 50-day moving average, the 200-day moving average, and the 10-day moving average. All right, so basic moving averages and levels, whether or not you're above or below the 50 and the 200-day moving average, you could use almost whatever moving average you want to measure trend. If you've got good stack, good slope on your moving averages, and the price action is strongly going in your direction, you don't have to get that complicated on trend. All right. Now, the job of having a good indicator is to make reading the trend and the price action easier. So the reason I say you don't have to be all that complicated about your analysis of the trend is because I'm accustomed to using this indicator down here, which is real motion. And this is proprietary to Market Gauge, but I'm going to show you how you can get it for free on the major market indexes. In fact, this is one of the charts. And the power behind real motion is that, one, it's momentum, and two, that momentum tends to go in a direction that's ahead of the market. And so when you can see it moving ahead of the market and then price beginning to follow it, that's when you have a situation where you can be more confident that your trend is going to change or your trend is going to continue. And it's as easy as this with real motion. So I have two time frames of real motion. The top one here is the 50 and the 200 period. Now I'm looking at days, so we'll call it 50 and 200 days. So again, the green line is the 200, the blue line is the 50, and this is momentum. The dots are the 1-day measure of momentum. So just like price and the 50 and the 200, this is measuring the same thing, but you'll notice that they aren't always doing the same thing. All right. So if I were to just read real motion the same way that I would read price action, I would be thinking real motion is positive through here. The dots are green because they're over the 50. It starts to turn negative here. It gets more negative here. Then it starts to turn positive here, right? And the whole time the 50 is over the 200. So that's bullish, right? So it's not that hard to read. But now if you combine this with what is it doing relative to price action, now you start to get some real insight into what to expect from price action. So without going into too much detail for the interest of time, real motion is trading under its 50-day moving average. So that's not good, right? That's a weakening of the trend. And it's starting to break down here, but it's still over the 50. But if this is already breaking the 50, I'm going to anticipate that this break of the 50 is going to continue lower. All right. It's as simple as that. So when the same thing happened over here, it's consolidating at the 50, and real motion is not just breaking the 50, it's breaking the 200. This is telling me that's a divergence. All right. Remember, that's one of the check boxes. This is a divergence. And not only that, it's a leading divergence. So as soon as this breaks the 50, now the price is doing the same thing. And I'm going to expect that it's going to continue to break, right? Like it did. So there's a lot more you can do it with real motion. You can see the Bollinger Bands on here. That's a measure of overbought or oversold, right? So in this case, the real motion is oversold. When price got down to oversold, now they're both oversold. That's one of our mean reversion patterns. And so I'm not going to just buy it because it's oversold. It would have been great if you'd done, you would have bought the low, but that's not how I would use it. I would wait for it to get oversold and then come back, show some progress in the opposite direction back into the bands here. This is in the bands here. And that would tell me we got oversold. We're starting to turn higher. So I've got that oversold box ticked in this case. All right. Now, again, in the interest of time, this is the 50 and the 200. This is the same thing, just measuring your 10-day and your 50, right? 10 and 50. Now, I've circled this area in here because you can see the 10 is under the 50 here. All the while, the 10 is over the 50 here. That's a divergence, right? Now, I'm sure some of you are probably thinking, well, that didn't work very well. I missed this whole move up. So what good is that divergence? Well, the way to use a divergence is not to assume that the price action is going to do what the divergence is doing until it does, right? So when you see this divergence like this, you're going to wait until the price action really shows that it's breaking that 10. And more importantly, it's breaking the 50, the longer term moving average. All right. So when this broke the 50, I knew that I didn't want to trust that 50 to hold because I had the short term measure with a divergence. I had the longer term measure breaking down below it. So I had two different time frames suggesting that the market had too much momentum on the downside, right? In this situation up here, the divergence wasn't as long, but this turned negative a week before we broke. So a week before we broke, you would have been looking at this saying this market is probably going to break the 50. And if it does, it's probably going to go lower. And if you remember what happened back in July of 2024, it did go lower. It went substantially lower. All right. So that's all I've done here is gotten started in the sense that I'm just talking about looking at basic price, right? One of the things that moves markets, and really simple measure of momentum. All right. Now, again, when we're working with the market, one of the best ways to anticipate which way the market's going to go is to look at these four charts. All right. Again, I told you a lot of this stuff is free, and sometimes the free stuff is the most powerful to get started. If you populate your charts with the SPYs up here, the Qs up here, the Dow, and the IWM, and look for this one thing, this one question. Are they all doing the same thing? Are they all doing the same thing relative to their trend? Are they all doing the same thing relative to their momentum? Most of the time, the answer is no. But if the answer is yes to at least the two major ones, SPYs and Qs, or three of the four, then the market's probably going to continue to do that thing, whether it's reversing, whether it's trending. If they're all doing completely different things, then it's probably going to be choppy. It's most likely not going to be a continuation of the trend. If you have a couple of them changing their trend, then it's probably going to be a change in trend. All right. So in this case, we can see that they were pulling back, breaking down, momentum, breaking down. So there were good reasons from a longer term perspective in the summer of 2024 when the market started to break down to expect that there was going to be more to come. But more importantly than just that one event, look at these four all together. Are the price trends similar? Are the real motion trends similar? And you'll be way ahead, right? We'll come back and look at what the market looks like right now with respect to all these. But for now, let's take a look at the ways to look at leadership. All right, so this is an indicator that I don't think gets enough attention, but it's talked about all the time. All right, new highs, new lows. What's making new highs? What's making new lows? Most people are more focused on the individual stocks that are making new highs and less focused on the number of stocks that are making new highs. So there are two different charts here. The first one, and we're looking at NASDAQ first. The first one is just the total number of new highs, total number of new lows. The easy interpretation of this chart is that if you're over 100, this line, you're doing pretty well. If you're under minus 100 in the stocks making new lows, that's not so good. All right, that's bearish. But the art to this is which direction is this going, and is there any kind of a divergence? Now, in this particular case, the summer high was a very unusual situation, so I'm not going to go into overanalyzing that. This was actually would have looked good, right? After seeing no real interest as the markets just kind of ground higher. And in fact, it was looking pretty bearish. All right. There were more stocks making new lows than there were making new highs as this moved higher. Now, if you were looking at this, you could have looked at it as it was happening and said, well, that's completely doesn't make any sense. But if you remember this time period, everybody was on top of the fact that this market was really narrow. There really was not a lot of leadership. And it was that caused the market to get hit so hard because the stocks that were going up were the large tech, large cap stocks that really moved the index value itself. So with everything else being weak, and then they finally got weak, that's why the market got so weak so quickly. All right. So that was a little bit of a warning. This was definitely a head fake, it going higher like that. But it quickly reverted back as we were breaking the 50-day moving average. These were new highs were falling apart. That's not what you want to see. New lows were beginning to get more. That's not what you want to see. And so that was telling you that the leadership was getting weaker. Now, if we look at this chart down below, it's another version of new highs, new lows. And for some people, it's just easier to read. The easiest read on this is this green line is a 10-period moving average of the ratio between new highs and new lows. Now, I don't expect you to all be writing this down and taking notes on that. But if you were to go to our site, you can see what the formulas are. The more important thing is that the green line, which is the fast line, if you basically say I'm going to go in the same direction as the green line, that's generally pretty good. It's more powerful if your green line is also confirmed by the number of new lows or the number of new highs also going in that direction. In other words, being high. But essentially, if the green line is below 30, the market is weak. All right. So even though this looked like it was strong, this is telling you that it's weak. All right. And the reason it's telling you that it's weak, it's because the ratio of these two, right? So it wasn't looking at this, it wasn't surprising to see that the market was likely to sell off. Now, when it gets up here, the market should be strong, but But when the market goes from strong to rolling over to coming under 70, that's the alert to watch out for weakness. All right. So looking at these charts, we start from here. We go from being strong after this weird environment of going up on narrow to rolling over. That's your sign that the markets, whatever leadership there was, is now weakness. And when you go from being strong to weak, it usually needs a break and sells off. All right. So just by looking at how this ebbs and flows, so here you'd start to turn more bullish. Here you'd get cautious. Here is kind of mixed. There's no real direction. And then here you start to get bullish again. All right. So down here it's weak, right? This is breaking. This is weak. It sells off. It starts to turn higher as we're consolidating. It turns up over that 30 line and trending higher, and then you're off. All right. So again, it doesn't have to be complicated. And one way to make sure you don't make it complicated is you're not trying to figure out what's going to happen every single day. It's the main trend. All right. All right. So I'm going to come back to sectors when we look at the actual page. But one of the ways to understand how strong the market is, and this was really true yesterday when the market got crushed by DeepSeek. If you took tech and semis out of yesterday's sector summary, almost everything else was up. It really was a bullish day. It's just the most popular part of the day. Sorry, the most popular part of the market got crushed. But if you were looking at the sectors and looking to see what the general market was doing, it wasn't easy. It wasn't hard to see. In fact, it was easy to see that the market really wanted to go higher. The market was telling you that it wanted to go higher, which is what happened today. But all the news was about the big drops. All right. I'm going to come back to, no, I should explain this. All right. So in this chart, we've got real motion. We already explained this. And then we've got our leadership line down below, which we call triple play. And triple play is a measure of relative performance across multiple time frames, where the red line is the fastest one, the blue is the intermediate one, and the black is the longer term one. All right. So yeah, you can go out and get relative strength, not RSI, but relative strength on a lot of charts. But this chart is showing you how that performance is measured over 3 different time frames, and that's really where the power of this lies. If you just look at whether the red line is over or under the blue line, it's incredibly powerful, right? So if we were looking at SMH, and looking at it during, again, in the summer period, we would have seen that it was on a leadership line perspective, bullish all through here. You got a little bit of a warning here, but again, keep it simple. It's got to be a bigger break than that. And then the SMH makes a new high, but its leadership did not. There's your divergence. All right. The bullish trend that you had here is no longer bullish necessarily. And you've got a divergence. And then it pulls back to the 50-day moving average, right? The question of the day, is this thing going to hold the 50-day moving average? Well, we already have our momentum, which we've talked about here, saying, no, it's probably not going to hold. We've got a divergence in the shorter term one. So again, no, probably not going to hold. And then how is it doing in terms of its leadership? Well, it's not doing great. I mean, you can get it to look worse, but that's certainly not the sign of a leader, right? A good leader that's pulling back is not breaking the blue line. And then as soon as it breaks here, it is, in fact, I shouldn't say that. As soon as it breaks here, it's already well below the blue line. All right. So what's going on here? I said this should be easy. Once you understand how to use just these indicators, and I'm just getting started, is the price trend still going up? Questionable because it's pulled back. So it's really either consolidating or pulling back. Momentum um, on this time frame, bearish. In this time frame, bearish. We've got a divergence on the leadership here. You could also argue we have a divergence in momentum here. And then leadership is breaking at the same time that the price trend is breaking. So that when you get to the point where you're saying the price trend is breaking by my definition because it's breaking below the 50-day moving average, you have all these other indicators, checking the boxes, and you should expect more weakness. All right. Now, I'm not going to spend a lot of time on this one. This is a second indicator in our triple play package, which is a volume trend. And we read it the same way. If the red line is over the blue line, then it's bullish trend. If it's under, it's bearish. When this was breaking down, this was weak. As it broke down, it got weaker. And so from a volume perspective, it's breaking down too. So just to quickly review, look at all the information you have about the SMHs right here. You've got price, you've got momentum on two different levels, you've got leadership, and you've got a volume trend, right? I mean, that's more than enough. You don't overthink it. Having said that, we will give you more if you want more. I'm not going to spend a lot of time on this, but I wanted to illustrate it because this is the idea of the seasonality that I talked about. So this is the SPY, the S&P 500, and what its seasonal tendency is, right? So this means that January is or has been since 2015. On average, generally been up. February, the middle of January to about the end of February has been somewhat bearish. And then you've got a nice bullish run from the beginning of March, middle of March, up until the end of June. And then it's kind of bearish until the end of September. And then it gets bullish. And then into December, it's slightly bullish. So that is the seasonal trend of the SPYs over the last 10 years. Now, does that mean that every year is going to do the same thing? No. What it does mean, or one of the ways to use this, is that when you see that the market is agreeing with you, then you can be more aggressive or be more confident. All right. All right, so now I'm going to get into some stuff that's a little bit more esoteric in terms of measuring sentiment. So yes, you can measure sentiment by what people say. AAII, nice sentiment indicator, don't disagree with it. But that isn't what people are doing. That isn't what the market is doing. That is just what people are saying they're going to do. When you start looking at the VIX, this is measured based on option pricing. And without getting into how it is all calculated, you're looking at short versus long-term option volatility. Again, this is based on options traders actually trading. Are they placing trades that are implying that they're more bullish or less bullish in the long run versus the short run? And so again, keeping it simple, if this ratio has the red over the blue, then it's generally bullish. If it's red under the blue, it's generally bearish. Now, this isn't an indicator that I would run out and say, okay, it just broke here, so the markets should be heading down. Again, the trick to being accurate with what the market's going to do next is to really understand your levels, right? So a lot of the reasons that I have a 10-day moving average on my chart is because I have found that looking at where the market is relative to that 10-day moving average is a great short-term indicator. So if I want to get bearish on a market that's been moving up, I'll wait for it to close under the 10 and then continue below that close. And that'll be my short-term indicator that the market could be in a short-term downtrend. Now, if I see that happening, I know that I am wrong if it gets back over the 10 and continues higher. And if I see that happening and volatility has been bearish for the last several weeks as the market ran up, then it's pretty simple to see that the price action was not in agreement with the sentiment here, but now they're both in line. So at the beginning of this presentation, I said that if you put the market action at your back and it's doing the same thing as your trade, it's a lot easier. It's more profitable. Well, if you're taking multiple indicators in terms of confirmation and they're both going in the same direction, you're just waiting for the price action to confirm, your trading is going to be a lot easier. All right. Okay. Now, totally different indicator. We're going to talk about the economy without really measuring the raw economic indicators. And in fact, this is really sentiment. This one's sentiment more than the economy. So if you look at the relationship between the SPYs and the utilities, SPYs are generally more risk on. Utilities are generally more risk off. Now, you might argue with that a little bit now with the recent developments with power becoming such a risk on asset. But for all intents and purposes, XLU is still, in my opinion, a risk off. It just might have trends that are also go at the same time as risk on, but it's going to respond in general still as a risk-off asset. I don't know if I can say the majority of the time, but plenty of the time. This ratio still works. If you're looking at whether or not the SPYs are outperforming or underperforming the XLU, you can have a pretty good sense of whether or not the market has a risk-on or risk-off tone to it, and that helps you determine when to be bullish or bearish. Right? So here's the SPYs, right? This is XLU, but if you just focus on the SPYs and this over the SPYs, that's bullish wins at its back. In this case, it went higher. SPYs turned down on the ratio and the market's turned down. All right. Again, don't make it complicated. Don't use it as its only indicator. In fact, we use it in conjunction with 4 others. We look at the ratio of the SPYs versus the TLT. Same idea. If the SPYs are outperforming TLT, it's generally bullish. If they're underperforming, it's generally bearish. You have to understand the context because it's not always true, but it's a good starting point. High yield debt versus the TLTs is, again, high yield debt is a risk on asset. TLTs is generally risk off. So if you've got your risk on outperforming your risk off, that's how you know that it's risk on environment. SPY versus gold. Gold is generally risk off. Same idea. You look at a ratio. And then wood versus gold. Wood represents growth in the economy. Gold represents either inflation or safety. By looking at that ratio, you can get a sense of whether it's risk on or risk off. We add all of these up and we create this gauge, and that's our risk on, risk off gauge. All right, you're not going to find this anywhere else. And using that gauge all together, you can see that it gives you a pretty good sense of whether or not you should be bullish or bearish or neutral. And the way I use this is that if we're in a bullish trend and it turns neutral, no problem. If we're in a bullish trend and it turns bearish, that's a real warning sign. All right. Okay, so let's go look at the real charts. Now, before I do that, if you're interested in any of this stuff, whether it's real motion or triple play or big view itself, I'm going to give you a link later, but you can also just schedule a call with Rob. Rob's our telesales and chief strategy officer. So he knows all of our products. He's been helping traders like you figure out how to become better traders. And he'll do a free strategy call with you, which means figuring out how you want to approach the markets, whether or not we have any strategies, indicators, mentoring programs that can help you. Just go to marketgauge.com/call and you can set up a time with them. All right, so let's take a look at how this actually plays out in on our site. Oh, sorry. And if there are any questions, let me know. All right. So I am going to do one other thing. I'm at marketgauge.com. Sorry, got to get my annotating stuff back. All right. Are there any questions before I go through and show you what's going on right now and show you a few more indicators, and then we'll wrap up and be done. All right. So I'm at marketgauge.com. I'm in the tools section. The other thing I would encourage you to do, especially if you're not familiar with us, is go to our homepage at marketgauge.com and grab Mish's 2025 Market Outlook. It's totally free. She's got at least 10 trades. It's probably more like 15 trades that she's watching for the year. She does a unique analysis of what she expects for the year, which part of the uniqueness brings in, she brings in the Chinese New Year. So this year is the year of the wood snake. She ties that into the market. Told you there were other things that I didn't have on the list. And she also has a unique way of anticipating market direction using something called the modern family. And I'm going to show you a little bit of that in this too. But again, grab this. It's a free report. All right. And so then when you come here to marketgauge.com, you can go to tools and you'll be at Big View, which is what I've been showing you. This is the article that we put out each week. Now I'm logged in so I can see all of these things, but just to warn you, all of this isn't free. But a lot of it is, so I encourage you to use it. Now you should recognize this chart. This is the four charts that I was just using. Now, the way this area of our site works is that when I click on it, it made all the charts bigger, and then I can set my browser to the size so I can see all four if I wanted to do that. Let's take a look at what's going on in the markets right now. So again, I couldn't rehearse this. I mean, I couldn't set this up, couldn't cherry pick it. So let's take a look if I do the same thing what I just told you to do. And so every Wednesday we have a mentoring session, and I go over what I call the three charts. They're not really three charts. They're three different areas of the market. And if you look at these, you'll have a really good sense of what's going on. So just quickly, here's the SPYs, real motion. Real motion is stuck, right? This is bearish. So if the market goes down, we want to be cautious. So when the market heads down here and the market's going down here, we want to be cautious because this is weak. All right. But the price trend, if the price trend is going up, then we're going to follow the price trend. All right. So in this case, the market's going up. We just don't want it to come down. Now, this doesn't include today, right? Came down and did what? It hit the level. All right. So landed on the level yesterday. Here are the cues. Warning here with the real motion. Looked like it was turned bullish. Then we got hit by the deep seek, landed on a level. We go to the Dow. Now, the Dow's been bullish. The Dow has turned bullish here. So if the other two are questionable, this one is bullish, this one is bullish. IWM, this one is definitely not bullish, right? Can't get over the 50-day moving average, and this is not bullish, right? So IWM, we need this to get over the 50 to be bullish. So until this starts to move higher and this starts to move higher and this breaks out, these three are, I would say, neutral, right? Trend looks okay, momentum not so good, neutral. But if which they did today, they rebound off the level, and I don't know what IWM did. Maybe someone could tell me if it broke out over the 50. I don't remember. But if that breaks out over the 50, then we've got a situation where ideally real motion will be flipping positive and all the price trends will be positive. All right. So right now, not necessarily a given. We have to see what the price action does, but I know exactly when I'm going to start to turn bullish. So the second charts are the ones that I showed you. They are, oh no, actually I didn't show you these. That's the third ones. The second chart is the McClellan oscillator. Now, I'm saying it's the McClellan oscillator because this is the easiest one. Let me make this smaller. All right. Sorry. Sorry. So the McClellan oscillator is a longer term advanced decline measure. Now, there's a lot of different inflection points to look at, but essentially we want to look at when it gets overbought or oversold. So when this gets, I should make this bigger. When this got oversold here on this measure, right? That actually lines up with this. Sorry, this should be over here. When it got oversold there, that was a first indication that this market is pretty beat up. And then what happened? The market kind of ground lower. It couldn't really break down, and McClellan wouldn't break down. So that's a divergence, right? That's a divergence. And the next thing you want to look for with McClellan is it coming from a negative is breaking back up through the zero line, which happened when we broke up through the moving average and we took off, right? So admittedly, before we had DeepSeek one-day wonder plunge, I would have been saying this really looks good. It really did look good. And so we went from really looking good to one day down. Now we've got a big up day, and this higher, this is actually bullish. This is a little bit of a nuance, but if you go from a oversold level, the next thing you want is overbought. And that first overbought, unless you're in a downtrend, is actually bullish. All right. That's a little bit of a nuance kind of stuff you learn if you hang around us, right? So overbought here after a long trend, good indication after an oversold level. Right now, that's on McClellan. Again, in the interest of time, I'm not going to go into these too far, but this is a short-term advanced decline line. And again, as the market was making new lows here and not able to move lower, this advanced decline line here was totally diverging. So it went from oversold, everything was oversold here. Everything was oversold here. And then the market made two new lows, not by much. And it had a divergence here, divergence on McClellan. So those were two indications that when we started to turn up, this thing should head higher. All right. Now, is that complicated or is it pretty easy to see? All right. So we look at that on the NASDAQ, sorry, on the NYSE, and then we also look at the same thing on NASDAQ. Again, if you're looking at the markets, always look at multiple indexes. All right. And they were basically saying the same thing. All right. So when I look at the current situation here, if the markets continue to move higher, we should be following it higher if all you did was look at what I've just shown you so far. All right. It was a one-day hit that didn't follow through to the downside, and it's actually turning around and moving higher. And the internals are telling you that the market was strong. And this is what I said earlier, even before we look at the sector table. The market was strong. If we look at the new highs and new lows, we've got a decent number of new highs, not a lot, pretty muted, but no new lows, right? And when we were going down, there were no real new lows. It wasn't pushing to new lows, right? They just weren't piling up. So it wasn't a very aggressive push to the downside. And then as soon as it started to head higher, everything flipped here. The new lows came right up. The market is broadening out. It's strong underneath, and that's the SPYs. We look at NASDAQ and we look at the new highs, new lows. They're not overly bullish for sure. I would call them neutral, but there's certainly, when the market was selling off, they were not breaking down. If you want to see what breaking down looks like, here's something that's got more historical perspective. This is what breaking down looks like. All right. This is what breaking down looks like. This is not what breaking down looks like. All right. The market had a solid foundation when we had that gap down yesterday, and the gap down didn't change anything in the numbers. All right. That was a pretty strong signal that the market was going to hold up. Now I want to go to the sentiment, which we already talked about, and point out that moving up here, sentiment had turned higher. It got clocked right here on that one day. But I'm pretty sure this is going to bounce back, right? I haven't updated it for today yet. Pretty sure this is going to bounce back. And as long as this kind of stays on the upswing, because the trend here is up, as long as it stays on the upswing, this is going to be bullish, right? What does bearish looks like? Bearish, here's your spike down, and then it just continues to trend lower until it turns higher. All right. So if you look at the ebbs and flows of this, since September, since when I was showing the charts before, it's falling right in line with what I showed you a few minutes ago. All right. It's a much purer way of looking at sentiment. Now, I didn't talk about this one, and I know I'm just about out of time here. But this is another indicator that is incredibly powerful when it comes to identifying potential turning points. And this is the number of stocks that are over the 50, 200, and the 20, the 50, and the 200-day moving average. And if all you did with this was look at the magenta line, and when it gets from one extreme to the other, it's usually a really good indicator of a short-term overbought or oversold level. So as we were pulling back here, again, we had the initial oversold reading, a matched oversold reading on this low, and a divergence when it made this low, right? So, and then you had the 50 all the way down, the blue line all the way down here, which is really washed out. 50 really washed out. So by looking at these levels, we could see that the market has gotten oversold. It was diverging, rallying back up. All right. And I don't think I'm going to go into seasonality. Oh, sectors. Nope. Sectors on, risk off. I just want to encourage you to use this. So if we go to sector summary here. Now, this is today. And I'm not going to go through all these indicators here. Actually, the phase is what the 50 and the 200 are doing. But if we look down underneath, this is what I wanted you to see, and then we'll call it a wrap. Here are the same charts that we were just looking at, real motion and triple play on the SPYs, the Qs, and the TLTs. All right, one thing I want to point out with the TLTs, because you're not going to see this anywhere else, is the TLTs here are on real motion. They're over the 50. So this is telling you that this is likely to move higher, this divergence in here. It's small. And then this, if this gets over the 50 and that gets up to the 50, we could expect it to break higher. So there's some good oversold indications here on the TLTs, divergence here. I didn't talk about that, but that one. So that's worth noting. And then when you get to the individual sectors, you can see real motion and triple play for all the sectors. All right. I said earlier that I would show you how you could get this and be able to see this even without buying the indicators. If you just want to see how powerful this works, I encourage you to go to marketgauge.com, go to the sector summary page, get Mish's report, and then finally, if you want to become a member, we've got an extremely inexpensive trial on the premium. So one of the things you'll get with the premium is not only access to all the indicators, which I couldn't go through all of them, but you'll also get access to Keith, my partner at Market Gauge, does a video every every week where he goes through the whole big view, points out the things that he sees as being important. So he's teaching you how to use this every single week. All right. And the way to get a special deal on that is either to give Rob a call here. That's marketgauge.com/call. Or you could go to this URL, marketgauge.com/sales/bigviewCTA. I know that's not the easiest way to get there, but an easier way to get there would be that if you are not logged in and just click on any of the things when it doesn't, I'll put the link in the chat. If you click on a link that you don't have access to, it'll ask you if you want to learn more. And we've got a $7 trial. All right. So this is just a summary of everything. And right down here for a limited time, you can get 14 days for $7 and be able to see the whole thing. All right. There haven't been any questions leading up to now. If you do have a question, I'll stick around for a few minutes. But I know that I am a few minutes over my time, and I will call it a wrap. I'll leave it with one thing, and that is, look, learn how to read the market, and your life will be a lot easier. All right. It's a little bit of art, it's a little bit of science, but anybody with an open mind can do it. And we're here to help if you need it. That's it. Thank you very much, everyone. Have a great day.